Every single day, trillions of dollars move through the stock market. It has created some of the richest people in history. It has helped ordinary factory workers, teachers, and nurses retire with six-figure savings they never thought possible. It has fueled the rise of the largest companies the world has ever seen, companies that now shape how billions of people communicate, shop, travel, and live. And yet, if you stop the average person on the street and ask them what actually happens when they buy a stock, most of them couldn't tell you. They know it's supposed to go up. They know people talk about it on the news. They might even own some shares through a retirement account without fully understanding what they actually hold. So today, we're fixing that. We're going to take apart the single most powerful wealth creation machine in modern economic history, piece by piece, until you understand exactly how it works, why it works, and why so many people misunderstand it. By the end of this video, you'll know more about the mechanics of the stock market than most people who have been investing in it for years. Before we talk about what a stock is, we need to understand why the stock market exists at all, and why it has become arguably the most important financial institution in the modern world. At its core, the stock market is a meeting point, a place where people who own pieces of businesses can sell those pieces to people who want to buy them. That's it. Strip away the financial news anchors, the flashing red and green numbers, the dramatic headlines about crashes and rallies, and what remains is remarkably simple. It's a marketplace for ownership. But the scale of that marketplace is what makes it extraordinary. The combined value of publicly traded companies across global stock markets exceeds $100 trillion. To put that in perspective, that's larger than the combined economic output of every country on Earth in a given year. Every major technology breakthrough, every new hospital built, every factory expansion, every product that reaches your doorstep, much of it was financed at some point through this system. For ordinary people, the stock market has become something even more personal. It's the engine behind most retirement accounts in America. It's the reason a school teacher contributing a modest amount every month for 30 years can retire with several $100,000. It is quite literally one of the only systems in modern history that allows an average worker without inherited wealth, without a finance degree, without insider connections, to own a piece of the world's most successful companies and grow wealthy alongside them. Understanding how this machine works isn't just intellectually interesting. It's one of the most financially consequential things you'll ever learn. So let's start at the most basic possible level, with the question almost nobody can actually answer with confidence. What is a stock, really? Imagine a company as a pizza. A whole, freshly made pizza sitting on a table, representing everything that company is worth. Its buildings, its products, its brand, its future earning potential, all of it. Now imagine that pizza is cut into 1 million slices. Each slice is identical. Each slice represents an equal tiny fraction of ownership in that entire pizza. A stock is one of those slices. When you buy a share of a company, you are not lending the company money, and you are not buying a coupon for a discount on their products. You are buying a literal, legal piece of ownership in that business. If the company has issued 1 million shares total, and you own 1 share, you own 1/1,000,000th of that company, its assets, its profits, and its future. This is a profound shift in how most beginners think about stocks. People often talk about playing the stock market as if it were a casino game disconnected from anything real. But every share represents a fractional claim on an actual operating business, with real employees, real customers, real revenue, and real decisions being made by real executives every single day. Take a company most people recognize immediately, a major coffee chain with thousands of locations worldwide. When you buy a single share of that company, you now technically own a tiny fraction of every espresso machine, every lease, every ounce of brand value the company has built over decades. You don't get free coffee, but you do get a claim on the profits those stores generate multiplied across millions of shareholders just like you. That ownership is the foundation of everything else we're about to discuss. Once you understand that a stock is a slice of a real business, the next logical question becomes obvious. Why would any company want to sell off pieces of itself to strangers in the first place? Companies don't sell shares because they're generous. They sell shares because they need something, and the stock market is one of the most efficient ways in human history to get it: capital. Imagine a promising electric vehicle startup in its early years. It has brilliant engineers, an innovative design, and a compelling vision. What it doesn't have is enough cash to build factories, hire thousands of workers, and manufacture vehicles at scale. Building a single car factory can cost hundreds of millions, sometimes billions of dollars. The company has a few options. It can borrow that money from a bank, taking on debt that must be repaid with interest regardless of whether the company succeeds. Or it can sell ownership stakes, shares, to investors who are willing to provide capital in exchange for a piece of the company's future. If the company succeeds, those investors share in the upside. If it fails, the company isn't strapped with debt it cannot repay. This is precisely why a company goes public through what's called an initial public offering, or IPO. It's the moment a private company opens itself up to public ownership for the first time, selling shares on a stock exchange to raise the capital it needs for its next chapter of growth. Building factories, hiring talent, expanding into new markets, funding research. Once a company is public, it doesn't need to keep issuing new shares constantly. Existing shares simply trade between investors on the stock market day after day. The company itself only receives capital during specific events like the original IPO or subsequent stock offerings. But the existence of that public market, where shares can be bought and sold freely, is precisely what makes investors willing to provide capital in the first place. Nobody wants to invest in something they can never sell. This single mechanism, companies raising growth capital by selling fractional ownership to the public, has financed nearly every major technological and industrial advancement of the last century. Which raises the next critical question. If you're the one buying those shares, how exactly do you make money from them? There are exactly two ways an investor earns money from owning a stock. Understanding both completely changes how you look at every stock tip you'll ever hear. The first is capital gains. This is the one everyone already intuitively understands. You buy a share at one price, and if the company grows, becomes more valuable, and more investors want to own a piece of it, the price of that share rises. You can then sell it for more than you paid, capturing the difference as profit. Let's make this concrete. Imagine you buy 10 shares of a growing software company at $50 each, a total investment of $500. Over the next several years, the company expands its customer base, increases its profits, and becomes significantly more valuable. The share price climbs to $120. Your 10 shares are now worth $1,200. You've made $700 in profit without the company sending you a single check. The gain exists purely in the rising value of what you already own. The second way is dividends. Some companies, particularly large, established ones that generate consistent profits, choose to distribute a portion of those profits directly to shareholders, usually on a quarterly basis. This is the company literally sending you cash for owning its stock. Consider a major telecommunications company that pays an annual dividend of about $3 per share. If you own 200 shares, you'd receive approximately $600 a year in dividend payments consistently, regardless of whether the share price goes up or down that particular year. Many long-term investors specifically seek out reliable dividend-paying companies precisely because that income arrives like clockwork, creating a steady stream of cash flow on top of any price appreciation. Most serious long-term investors aim to benefit from both simultaneously: a rising share price over years or decades combined with dividend payments along the way. This combination is the foundation of how ordinary people, contributing modest amounts consistently over time, eventually accumulate genuinely significant wealth through the stock market. But if stocks can make you money in such clear, logical ways, why does the market seem to move so unpredictably day to day? Why do prices swing wildly, sometimes for reasons that seem to have nothing to do with how a company is actually performing? At the most fundamental level, stock prices move because of supply and demand. The same force that determines the price of literally anything bought and sold anywhere in the world. When more people want to buy a stock than sell it, the price rises. When more people want to sell than buy, the price falls. Every other factor we're about to discuss is simply a reason why that supply or demand shifts. The first major driver is earnings. Publicly traded companies report their financial performance every 3 months. If a company reports profits that exceed what investors expected, demand for its shares often surges, pushing the price up almost instantly. If profits disappoint, even by a small margin, the stock can drop sharply within minutes of the announcement. Markets aren't just reacting to how a company performed, they're reacting to how that performance compares to what was already expected. The second driver is news and broader events. A surprising new product announcement, a major lawsuit, a change in leadership, geopolitical instability, or unexpected developments in an entire industry can shift investor sentiment rapidly. News doesn't have to be about the specific company to move its stock. An interest rate announcement from the Federal Reserve, for instance, can move nearly every stock in the market simultaneously because borrowing costs affect how every business plans and grows. The third driver, and the one most beginners underestimate completely, is investor psychology. Markets are not purely rational. They are driven by millions of individual humans, each interpreting the same information differently, each reacting with their own mixture of optimism, fear, and assumption. This is why stock prices sometimes seem to overreact to news, surging or crashing far beyond what the actual business developments would logically justify. Fear spreads quickly. So does excitement. Both can move prices dramatically before fundamentals ever catch up. Think about it this way. Imagine two friends watching the exact same quarterly earnings report from the same company. One friend, an optimist who already believes in the company's long-term vision, sees the results and feels reassured, holding onto their shares confidently. The other friend, more anxious about a recent slowdown in one division, sees the same numbers and feels nervous enough to sell. Multiply those two reactions by millions of investors worldwide, all processing identical information through different emotional and analytical lenses, and you start to understand why short-term price movements can feel almost chaotic, even when nothing fundamentally dramatic has actually happened to the business itself. Understanding this distinction between a company's actual underlying value and the market's short-term emotional reaction to it is one of the most important lessons in all of investing. But it also leads directly into something every investor needs to be honest about: the real risks involved in putting your money into this system. The stock market is not a guaranteed path to wealth, and pretending otherwise would be dishonest. Real risks exist, and understanding them clearly is what separates a prepared investor from one who gets blindsided. The first risk is volatility. Stock prices can swing significantly in short periods of time, sometimes for reasons that have little to do with a company's actual long-term health. An investor who needs their money back in the short term, within a year or two, is taking on real risk that the market simply won't cooperate with their timeline. This is why short-term trading is fundamentally different and considerably riskier than long-term investing. The second risk is market crashes. Periodically, often triggered by economic recessions, financial crises, or unforeseen global events, the broader market can decline sharply, sometimes 30% or more, within months. These events are painful, frightening, and historically temporary. Markets that have crashed throughout history have eventually recovered and gone on to reach new highs. But living through a crash in real time, watching your account balance shrink, requires genuine emotional resilience. The third risk is company-specific failure. Not every business survives. Some companies go bankrupt entirely, and their stock can become worthless. This is precisely why diversification, spreading investments across many companies rather than concentrating in just one or two, matters so much. An investor holding shares in a single failed company can lose everything they put in. An investor holding a broad, diversified portfolio is protected because no single company's failure can sink the entire investment. The fourth risk and arguably the most dangerous one for ordinary investors is emotional investing. Buying out of excitement when prices are already high, then panic selling out of fear when prices fall. This single behavioral pattern has cost ordinary investors more money throughout history than market crashes themselves ever have. The market doesn't punish patient investors nearly as often as it punishes emotional ones. These risks are real, and acknowledging them is essential. But here's the remarkable part of this story, the part that explains why, despite every crash, every recession, and every moment of panic throughout history, the stock market has still managed to build more ordinary wealth than almost any other financial system ever devised. Zoom out far enough, across decades rather than days, and a clear pattern emerges. Despite wars, recessions, pandemics, and financial crises, the overall stock market has consistently trended upward over the long run. Understanding why requires understanding what the stock market actually represents in aggregate. The stock market, taken as a whole, is essentially a reflection of human innovation and economic growth. Every decade brings new technologies, new industries, and new efficiencies that didn't exist before. The personal computer, the internet, smartphones, cloud computing. Each of these innovations created enormous new business value. And that value was reflected eventually in rising stock prices across the companies that built and benefited from them. Business growth compounds this effect further. Successful companies don't just survive, they expand. They enter new markets, develop new products, and increase their profits year after year. As millions of companies across the economy pursue growth simultaneously, the combined value of the stock market tends to rise alongside the broader expansion of economic activity. Productivity plays a quieter but equally important role. Over time, businesses find ways to produce more value with the same or fewer resources through better technology, better processes, and better management. This rising productivity translates directly into higher profits, which over time gets reflected in higher stock valuations. Consider this historical perspective. Someone who invested in a broad market index fund in 1980 and simply held it through multiple recessions, the dot-com crash, the 2008 financial crisis, and the pandemic-driven crash of 2020, would have seen their investment grow by well over 20 times its original value by today, even after accounting for every single downturn along the way. The short-term path was anything but smooth. The long-term trajectory was unmistakably upward. This long-term upward trend doesn't mean every individual stock succeeds, and it doesn't mean every year is profitable. But it does explain why time, patience, and broad diversification have historically rewarded investors who stay the course. Which makes it especially frustrating that so many beginners, full of enthusiasm but lacking experience, make the exact same avoidable mistakes year after year. The single most common mistake beginners make is trying to get rich quickly. They hear about someone who made huge returns on a single stock and assume that's the normal expected outcome of investing. In reality, those stories are rare exceptions, amplified by social media because they're exciting to share. The actual evidence overwhelmingly shows that slow, consistent, long-term investing outperforms attempts at quick wins for the vast majority of people who try. Closely related is the mistake of chasing hype. A stock surges in price because of social media buzz or breathless news coverage, and beginners rush in late, buying at an inflated price driven by excitement rather than the company's actual value. Often, by the time a stock becomes a trending topic, much of its growth has already happened, and the latecomers are simply buying in just before the enthusiasm fades. Panic selling is perhaps the most financially destructive mistake of all. When markets decline, fear takes over, and beginners often sell their investments at the worst possible moment, locking in losses that would have recovered had they simply stayed invested. Historically, some of the best market days have occurred within days of the worst ones. Investors who panic sell during downturns frequently miss the recovery entirely. Failing to diversify is another widespread error. Concentrating all your money into a single stock, no matter how promising it seems, exposes you to risk that a broadly diversified portfolio simply doesn't carry. Even the most celebrated companies in history have experienced devastating multi-year declines. Diversification doesn't eliminate risk, but it spreads it intelligently. Finally, many beginners simply ignore the power of long-term investing altogether, checking their portfolios daily, reacting emotionally to every small fluctuation, and losing sight of the bigger picture. Wealth built through the stock market is rarely built quickly. It's built through years of patient, consistent participation, which leads directly to the most important practical question of this entire video. For someone just starting out, the good news is that you don't need to become a stock-picking expert to participate successfully in this system. One of the most accessible and historically effective tools available to ordinary investors is the index fund. An index fund is a single investment that holds shares in hundreds, sometimes thousands, of different companies simultaneously. Rather than betting on which individual company will succeed, you're essentially betting on the growth of the broader economy as a whole. This single tool solves the diversification problem almost entirely, spreading your investment across an enormous range of businesses with one purchase. Diversification, as we've discussed, matters enormously. Spreading your investments across many companies, industries, and sometimes even countries significantly reduces the risk that any single company's failure can meaningfully damage your overall portfolio. It's one of the few genuinely free lunches in all of investing. A long-term mindset is equally critical. Money invested in the stock market should generally be money you won't need for at least 5 to 10 years, ideally longer. This time horizon allows your investments to ride out inevitable short-term volatility while benefiting from the market's historical long-term growth trend. Perhaps most importantly, consistency tends to outperform timing. Rather than trying to predict the perfect moment to invest, many successful long-term investors simply contribute a fixed amount on a regular schedule, regardless of what the market is doing that particular week or month. This approach, often called dollar-cost averaging, removes much of the emotional guesswork from investing and builds wealth steadily over time, one consistent contribution after another. None of this requires financial genius. It requires understanding the system, accepting realistic timelines, and consistently participating in it. Which brings us to the real truth about what the stock market actually is. The stock market is not a casino. It never was, despite how often it gets portrayed that way. At its core, it is a system that allows ordinary people to own genuine pieces of real businesses and participate directly in their growth, their innovation, and their success over time. It has flaws. It carries real risk. It can be volatile, unpredictable in the short term, and occasionally frightening to watch. But viewed over the long run, it remains one of the most effective wealth-building systems ever created. Not because it promises quick riches, but because it rewards patience, consistency, and genuine ownership in the businesses that drive the modern economy forward. Understanding the stock market is only half the story, though. Because owning the right assets is just the foundation. The real magic happens when time enters the equation. In the next video, we're going to explore how compound interest quietly, almost invisibly, turns small, consistent investments into genuinely life-changing wealth, and why understanding it might be the single most valuable financial lesson you'll ever learn.